global markets are drowning in a flood of oil. OPEC members had hoped to strike a deal with Russia to cut output and mitigate the impact of an economic slowdown caused by the coronavirus. But Moscow says low oil prices suit it just fine. The snub has driven Saudi Arabia to launch a price war.
Saudi Arabia has decided to increase output in a time when there are so much of inventory out there and not much of demand. So this will definitely lead to an oversupply situation in the oil market, and the price can fall even more from here.
That slashed market rates for the fuel by more than 20% on Monday. And the fear of an oversupply is adding to an already long list of concerns for international investors.
So we are already in a worst sentiment ever since the subprime crisis. Consumer confidence was dampened, and the global growth outlook has been cut a few times because of the trade war last year and COVID-19 this year.
Most major stock markets plunged on Monday. A 7% dive on the S&P prompted regulators to suspend trades soon after the opening bell. Returns on the US Treasury bonds fell to a record low of 0.318%, and the Japanese yen jumped 3% as investors rushed to move money to safe haven assets.
Well, I think what we are witnessing is a once-in-a-decade stock market crash, like 1987, 1997, 2008 financial tsunami, and now 2020.
Investors are worried that low oil prices will make it hard for producers to cover expenses and repay debt. The UN says the coronavirus outbreak could drive global foreign direct investment down by as much as 15% this year. And the double hit from falling profits and investments may see many energy companies running out of fuel. Mobin Nasir, TRT World.
Well, for more on the oil crash, let's go to Ranjith Raja, who joins us live from Dubai. He's the head of Refinitiv's oil and shipping research for the Middle East, North Africa region. Welcome back to Money Talks, Ranjith. Firstly, let's look at what triggered this crash in oil prices. And that was essentially the collapse of the so-called OPEC Plus talks that we saw in Vienna. Why did we see Saudi Arabia reacting this way?
So going into the OPEC meeting the end of last week, the expectation was already there because Moscow was not completely on board in terms of the proposed extension of the deal and also increasing the production cut agreement. And we were hoping that there would be some kind of an agreement that could be agreed and that could be arranged by the end of the meeting. And the failure of such an agreement is essentially what resulted into a huge tailspin in terms of the prices that we saw earlier this morning on market opening. But the market also reacted on closing Friday. The prices closed down almost 10% down on Friday. And on market opening today, it went down to as low as about $31.3. But the prices are already starting to recover. So I think the recovery is already in place. But it is more of a market sentiment and Saudi wanting to make sure that they are reacting in terms of maintaining or capturing the market share when the time comes in April.
Yes, now on that question of who will blink first, do you think Russia may perhaps cave and agree to those proposed output cuts, the further cut of 1.5 million barrels per day?
So not necessarily, because Russia was very clear going into the meeting that they were not going to agree for an extension or a deepening of the production cuts at any point in time. So they have been sticking to their end of their decision. And I think going into the meeting in terms of the Russia, they're also very confident that the results that they have is sufficient enough and the revenues that they would be able to make at the current oil price was sufficient for them for their budgetary requirements on the revenues that they were making. But that being said, at this current price point, it is not going to be sustainable for the long term, which essentially means there will come a point where they will have to come back to the table for further discussions.
Okay, we'll see what happens. Ranjith Raja from Refinitiv, thank you so much for your analysis as always. Well, the oil price crash spilled over into Wall Street, with US stocks plunging 7% at the open. The sell-off, as we heard, triggered a circuit breaker on the S&P 500, which halted trading for 15 minutes. The measure was put in place after the 1987 Black Monday crash and was last activated in December 2008 at the depths of the financial crisis. Well, for more on the market carnage, let's speak to Gregory, who joins us live from New York. Hi, Katie. Well, as shares plunged around the world, trade on Wall Street, as we saw, was spectacularly suspended, with markets in the US facing their worst day since the 2008 financial crisis. Just how bad were things on Wall Street?
Oh, this has just been a hugely significant day here. As you say, I'm at NASDAQ headquarters. You can see behind me the Dow Jones still down 7% at the moment. As I say, hugely significant. Anecdotally, analysts are saying this is a day on markets we have not seen for a very long time. It is being described as utter carnage. The Dow Jones crashed over 2,000 points at one stage in the day. Now, that so-called circuit breaker to halt trading was triggered earlier in the session. As you see, stocks have and the indices have reopened, but still mass damage and mass carnage, as I say, on the markets here. And significant because, as you mentioned, we haven't seen that being triggered since December 2008 and since the grips and the depths of that global financial crisis. Now, today is already being dubbed another Black Monday. That, of course, in reference to the crash in 1987. And what we've seen playing out here was this perfect storm, really. We already had seen those fears from the coronavirus last week hitting markets. Again, today we saw again triggered by that sharp drop in oil prices after those OPEC talks collapsed. I mean, all sectors here today are in the red, but particularly we've seen the energy index plunge over 17%. Now, we have had some reaction from US President Donald Trump, who, of course, up until recent weeks has been crediting the stock market success with his administration's policies. And of course, we'd seen recent highs after highs on these three main indices here. But he's been tweeting today saying, quote, Saudi Arabia and Russia are arguing over the price and flow of oil. That and fake news is the reason for the market drop. So he's also saying that gasoline prices coming down is good for the consumer. So we are hearing reports now that the president will be meeting with Treasury Secretary Steve Mnuchin and other economic officials to weigh possible actions to sort of stem this fallout. But at the moment here, what we've seen is just mass panic selling, and it's doing little to do to strengthen the markets, really.
Now, given today's carnage, as you put it, what's the outlook going forward? Are we likely to see some sort of a correction on Wall Street in the coming days?
It's quite unlikely we're going to see a correction in the coming days, and that's because basically we haven't seen the full measures of this fallout yet. Like your guest was just talking about, the oil price and the fallout measures from that to come in the following weeks, the following months even. So again, we're still going to have this fear over coronavirus and obviously this drop in oil prices playing out. So it is unlikely, given the volatility and investor nervousness out there at the moment, that we are going to see any sort of correction. And analysts here are saying we are looking at more gloom to come. Some even mentioning the probability of recession. Now, I spoke to Chief Economist Peter Cadillo from Spartan Capital Securities here in New York. Now, he is saying we're not far from bear market territory and that markets are in panic mode. He says you cannot have a good economy if oil prices collapse. So the question is what can be done, I suppose, to halt the slide in the short term, if anything. Now, he says that the US Federal Reserve could come to the rescue, but the tools there are somewhat limited, and they may have to resort to, say, a new round of quantitative easing even. Now, we did, of course, see the rate cut, the emergency rate cut last week, and they do have a meeting next week on March the 17th. But this could cause some real disorders, he's saying, in the credit markets, and with the Dow moving into bear market territory, we could see levels going even lower. So there seems to be no reprieve here, particularly for the short term.
Now, as we know, the panic selling on global stocks is very much linked to this crash in the oil price. Now, with this row between Saudi Arabia and Russia deepening, are we now in a price war? Is that what analysts and investors think? And what does that mean for OPEC?
There's a lot of talk going on here at the moment, looking at $20 in 2020, of course, talking about the price of crude oil dropping to that $20 mark. Now, of course, this is bordering on a all-out price war. We haven't seen anything like this since 2014, and that is what is causing, this panic. There was already demand concerns because of the coronavirus and what that was going to do to fewer people traveling, fewer people just generally consuming. But now, to add on to that, there is this supply problem as we head into this supposedly oil price war. We saw prices today recording their biggest one-day fall since the Gulf War in 1991. OPEC has removed all limits on its own production. We're hearing from major banks who are downgrading their outlooks for oil price. Goldman Sachs even saying that we could see that $20, $30 mark hit, and the prognosis for the oil market even more dire than in November 2014 when that last price war started. So really, as we mentioned, the oil price markets and the crude markets, this takes a long time to play out. This oil that is being currently looked at isn't even hitting the market yet. So again, something that's really long-term and could have a long-term impact on growth demand going into 2020.
Okay, it's not looking pretty, is it? Katie Gregory in New York, thanks so much for that update.